Thanks for joining David, Kevin, and myself for the market update for the month of September. Markets were good again in September, so I was happy about that, but we can definitely tell that the weather has changed. It's getting a little cooler out there. The S&P 500 was up 2.28%. The S&P TSX was up 3.42%. And the MSCI EAFE was up 3.43%. So overall, another solid month for us. I'm going to pass you over to the guys, but as always, if you have any questions, please don't hesitate to give any of us a call, and they're going to dive a little deeper on what happened in the month of September. Take care.
Let's start by talking about interest rates. The Bank of Canada continued its easing cycle in the month of September, lowering its benchmark rate 25 basis points to sit at 4.25%. Now, this marks the third consecutive rate cut by the Bank of Canada, and this is aimed at supporting economic growth amidst lowering inflation. In the US, the Federal Reserve began its own rate cutting cycle, lowering its interest rates by 50 basis points to sit in the range of 4.75 to 5%. Now, this first rate cut shows that the Fed is confident in the downward inflationary trend and a softening labor market.
Economic data in North America has been mixed, but generally has been positive. The second quarter GDP number for the United States was revised upwards to 3%. So growth in the US is still pretty robust amidst a strong US consumer. Inflation has also been moderating in the United States, rising only 0.1% in the most recent reading to sit at 2.2% annually in the United States. So inflation is basically back to target in the US. A similar story has unfolded in Canada with PCE, or the Consumer Price Index, sitting at 2.5% as recently as August. So inflation is very much getting towards that 2% number here in Canada that the Bank of Canada wants to see as well. Unemployment figures in both the United States and Canada have ticked up only modestly. They're still towards historical lows. So I think the central banks are comfortable with that, and we do expect to see rate cuts continue in the future.
As we move towards the end of the year, there are several key factors that we are going to be keeping our eye on. The first is inflation trends. Continued moderation of inflation is going to be crucial for the Bank of Canada and the US Fed to continue our pathway of interest rate cuts. The second is economic growth. Sustained economic growth between Canada and the US will support market stability and investor confidence. The third are geopolitical developments. The current conflict between Israel and its adversaries in the Middle East could impact global markets and economic conditions. But as we've seen in the past with other types of conflict like this may cause some short-term market volatility, but more often than not, the market will continue to be positive. And it's important to keep that in perspective when watching short-term scenarios in your portfolio or in the markets as a whole, that we need to take a step back and look at this in a much larger picture.
Overall, the fourth quarter we expect should be positive as things are shaping up nicely from an economic perspective. Like we've talked about, we've got inflation moderating in North America. We've got central banks clearly starting a cutting cycle, which, all other things being equal, should be supportive of asset prices in real estate, stocks, and the bond markets. So hopefully before the year's through, we'll continue to build on what's already been a pretty positive year in 2024. But as always, if you folks have any questions, please don't hesitate to reach out to myself, Kevin, or Harry.
Take care.